Lonsec wishes to remind that the information we provide on our portfolios is general advice, and we encourage investors to read the PDS or seek professional advice prior to making any decisions on their investments.
Hi, I'm Martin Graf, Financial Leadership. We specialise in helping retirees look after themselves and their investments and get up to retirement. Today, we're very fortunate to be sitting down with an expert from Lonsec, Dan Maradi, who looks after the investment side of things, particularly the direct shares investments in the portfolio. We're going to get some expert and answers from Dan and the team to kind of talk about some topics from today.
Moving forward into the future, a little bit of uncertainty, interest rates on the rise, costs tightening, and people probably maybe not spending their money. Well, what's the expectations of dividends and franking as well too from these companies over the next few years?
The dividend profile of the Aussie market has been improving. Obviously, it suffered a huge setback because of COVID in FY20, and we're making our way back. We're not quite there yet, but look, balance sheets are very strong, and that sort of feeds into the payout ratios. The payout ratios are not there yet in terms of pre-COVID, but once again, we're getting there. In terms of the forecast dividend yield for the market, I think on a cash basis, we've just tipped over 4% at the moment for next year. And then I think the franking is there's no material shift in franking. So overall market is still between 65 and 70%. But that 4% or 4.2, I think it is now on a spot basis, it's really dominated by those big companies at the top, particularly resources. I mean, if you look at Rio, Fortescue, and BHP, they're almost at 10%. And because they've got such a big weight in the market, so that's really lifting the dividend profile of the market at the headline level. But if you look at a little bit deeper, like on an average or a median perspective, it's about 2.8. So, we've still got a pocket of the market that haven't even resumed dividends because of COVID. Your casinos, your Qantas, travel stocks, none of those are really paying dividends yet since the GFC, and the resources businesses are making super profits because of what's happening there. So I do think that the industrial end of the market is likely to upgrade their dividends, and the top end of the market is likely to normalize lower, because I don't think 8 or 9% dividend yield is a normal yield for BHP and Rio. But as long as iron ore is at 150, that is a sustainable dividend. That's the unknown factor. We don't know where iron ore prices are going, and if they stay up there, then that's maintainable. So net, given the balance sheets, the confidence of management is increasing. Gradually, COVID is getting behind us, and basically the dividend payout ratios are nudging higher. So I think we've got room for upgrades coming from a dividend perspective from an overall market. And the second part of that is banks. They're a huge part of the market. The balance sheets are strong. The interest rates going up is good for their margins, and credit growth is still pretty strong on that level. So and the bad debts are very much under control. And the COVID wasn't a disaster from that perspective. So I think we'll see bank. They won't return to the pre-GFC levels, to those payout ratios, because they were unsustainable. But I think there's room for upgrades for bank dividends, which will support the whole market dividend. So I think just around the 4% is the figure that I think is sustainable.